Markets setting up for a blow-off top rally. Hi everyone and welcome to Ainsley Insights, brought to you by Ainsley.com.au, the home of Ainsley Bullion, Ainsley Crypto, Ainsley Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back Dhruv. He's been talking about these cycles for so long now that we feel like we're part of this cycle as it unfolds. We seem to know each little twist and turn, but now you're talking about the potential for a blow-off top rally. Is it in the short term? Is it longer term? I'm very intrigued today. How are you going, Dhruv?
Good, Chris. How are you?
I'm good. Look, this blow off top rally, is it based on your bigger cycle? Is it something because we're seeing Bitcoin today, for example, really, testing those all time highs, looking like it's going to break out? How are you seeing the lay of the land?
Yeah, absolutely based on the bigger cycle. So for a while now, many months, we've been talking about this winner's curse phase starting to kick off. Some people will call it the banana zone, the everything bubble. And we've been watching liquidity conditions pointing out that, we haven't really seen an actual explosion of liquidity as yet, but the conditions are setting up for that. And you do need that explosion of liquidity to back up this final phase of the macro 18.6 year land cycle where you will see most assets rise together. Now, the last couple of weeks or almost months now, since feels like a distant memory, but the Trump tariff panic sell off, we've been tracking the recovery of that. And we're sort of saying that, look, based on the macro cycle, we would expect this to recover fully, put in new all-time highs, and then continue on the actual blow-off top phase of the macro cycle. That this was nothing more than a panic sell-off, a wall of worry sell-off, if you will. And while tracking the recovery, we were also saying that, look, as much as we believe that this will put in new all-time highs based on the macro cycle, certainly not a time for complacency. So it's important to track this recovery. And we were either looking for a lower high and then potentially the macro cycle had peaked, or the fork in the road that we were favoring was that it would put in new highs and continue on with the blow off top. So we were tracking the Russell, the DXY, the S&P, the US bond markets, and essentially as the recovery continued on, as more data came to light, it became clearer and clearer that the odds are we're going to put in a new all-time high and continue from there. Now, since then, we have put in a new all-time high, and now it's important that, since the panic of the Trump tariffs have vanished and markets are back at new all-time highs, to take that zoomed out approach once again, back to the macro cycle, back to the 18.6 year land cycle, and have a look at where we sit. Because while the tariffs were creating panic, we had zoomed out and said, okay, it's fine to zoom out now, but we really do need to zoom in a little bit during the recovery phase just to make sure we're on the right side of this. That recovery phase is finished. So it's okay now. I just wanted to take a step back, zoom out, and have a look at what we can actually see moving forward for the next 6 to 12 months, because the conditions are setting up for that explosion in liquidity that we would expect. It might not happen next week or next month, but because it is a long-term macro cycle, things are looking really, really favorable for that final phase. So I thought it'd be good to look at a few charts and just to show that we are on track with the macro thesis.
Excellent. And we'd love to see, well, that's the beauty of getting you on to keep talking about this, because we can see it unfold in real time. We can see where we are and what's likely to come next. While you're bringing whichever chart up you want to bring up first, because I know you brought a few along today. I am particularly interested, so keep this in the back of your mind. I'm particularly interested in what's going on with the bond market at the moment. So if we can somehow address that as part of this analysis, that'd be great as well.
100%. I think, keep the bond market is really at the crux for all of this. So very important, given that, it's one of the largest drivers of liquidity, whether it's based on low yields and high collaterals or just low volatility. Certainly something to look at. Now, look, I'll just start with the Fed. All eyes are on sort of whether they're going to have interest rate cuts coming up or not. This basically shows the probabilities. Now, these can change and they can change very fast. But based on the current situation, we're looking at no rate cuts this month. And then we're looking at, there's no meeting in August, but in September, odds are we're going to see, rate cuts of 25 basis points. Now, the market's possibly front running this a little bit. Just looking at, the possibility of this. Something that backs this up quite strongly is the Truflation data. So if we look at what the current numbers are on Truflation, I believe it's sub 2. There you have it, 1.75% for the US. that is, something that will allow the Fed to breathe a sigh of relief. And it does appear that unemployment's down as well. So at least for now, if we've got low inflation, the Fed will have that room to look at cutting interest rates. And really, what will back up this low inflation expectation is the bond market. So we would expect at least the 10-year yields to start, to continue rolling over, to show that the bond market is pricing in a reduction of inflation moving forward. And with the Fed then cutting interest rates, it wouldn't affect the yield curve as much as if the 10-year yields were moving up, and Fed rate cuts would affect the short end of the curve. But what I really want to draw people's attention to, more importantly than rate cuts, whether the Fed cuts rates at all, whether the 10-year yield rolls over or not, is the bond market volatility. So this is an important chart, I think. In purple, you've got the S&P 500. This is the global financial crisis. So the end of the previous land cycle ended with a global financial crisis. Now we're in the final phase of our current land cycle in the S&P. This is the Trump sell-off. We've put in new all-time highs, as we were saying before, and we would expect this to continue on into the final peak of the land cycle. Leading into the previous peak, what we can see here is in blue, we've got the 10-year yields. The yields actually stayed elevated leading into the peak. Everyone's waiting for this bond yield to roll over, which would increase bond collateral values and have a very positive effect on global liquidity. It would also give the Fed the room to cut interest rates without affecting the yield curve too much. But we can see leading into the previous peak, the 10-year yield just stayed consistently high. But what was trending down was this. This is the bond market volatility as measured by the MOVE index. And as the bond market volatility continued down, what that does is it reduces the risk premium on bonds, and it improves liquidity by increasing the amount of debt that can be created on lower risk collateral. So with lower risk premiums, even if you've got high yields and low collateral values, the lower risk premiums result in an increase in global liquidity. Now, this is where we are today. We're seeing that MOVE index trend down. We're seeing the 10-year yield stubbornly stay elevated. And this is annoying a lot of people that have been waiting for this to roll over basically since the Fed started cutting interest rates, sometime here. And we see the S&P putting in a very strong rally. So whether the Fed cuts interest rates or not in September, whether the 10-year yield rolls over or not, things are looking positive for global liquidity if the MOVE index simply continues trending down. So that's an important aspect for as far as the bond market goes. Now, the DXY is something that a lot of people are looking at. With the DXY, while we were tracking the panic sell-off and the recovery, what we were saying was, we've broken below this. We expect a back test off the macro 50% level for the DXY. That's this level here. What we were waiting to see is a break below this level to show that, initially we got that rejection. And after the rejection, we break below. That confirms a continued downtrend. So the DXY has been on a strong downtrend since earlier this year. And, that's something that you could expect just looking at the macro DXY cycle, which is a 16-year cycle. Now, while this downtrend is intact, we will see counter-trend rallies. And this is where, again, it's similar to everyone looking at interest rate cuts or the 10-year yield rolling over, expecting that the only way markets can rally is when the Fed is actually cutting interest rates or the 10-year yield is rolling over, but they're not looking at the MOVE index where the markets can rally in spite of neither of those two things occurring. You can actually see the DXY have an uptrend from here, and you will see, well, not you will, but you can quite possibly see markets rally with the DXY. Now, an ideal situation is the DXY rolling over that provides a tailwind. But a reason that you might see markets rally with the DXY rallying, now whether that rally from here is just a counter trend rally and the downtrend continues on, or whether this downtrend's done, we've got to take it one day at a time with this sort of stuff. But it's really this chart that I wanted to draw people's attention to today. This is something that's basically been driving global liquidity since the bottom of the cycle. This is the dollar-yen pair. And we can see that the liquidity cycle started Sort of normally these have had an inverse relation, because when the dollar is losing value against the yen, the DXY tends to be going down. So what we've seen since this liquidity cycle started is that risk has actually been rallying with the DXY quite often. And that's left a lot of people a little bit confused. And if you dig a little bit underneath the surface as to what makes up the DXY, about 13% is the yen. And you'll see that when the DXY is gaining strength against the yen, or when I should say the dollar is gaining strength against the yen and the DXY is rallying, we've been seeing risk rallying as well. And that's because of the yen carry trade. When the dollar gains strength against the yen, you can borrow yen cheaply and move that yen into dollar denominated assets for a better return. That yen carry trade has been driving global liquidity quite significantly since the bottom of the cycle. So you can see here the NASDAQ in pink and the dollar yen pair in blue. As the dollar gains strength against the yen, it's actually driving the NASDAQ up. And then as the dollar loses strength against the yen, the NASDAQ's recovering. Now, the yen carry trade, I can't remember exactly when it was, but somewhere along this line, you saw the yen gain strength against the dollar significantly. I think this was it. And you saw a huge correction. Now, you can see this has basically been driving markets, quite strongly since then. And it does look like the dollar is getting ready to break out against the yen now. So if we see the DXY rally, but the dollar's breaking out against the yen, we'll see global liquidity move up and risk rally with the DXY. If we see interest rates stay elevated and the US 10-year stay elevated, but the MOVE index go down, we'll see risk rally regardless of rate cuts. So the whole point of this is everyone's paying attention to rate cuts. That's probably not the thing to pay attention to. Everyone's paying attention to the DXY. That's, when I say it's not the thing to pay attention to, I mean it's not the only thing to pay attention to. Of course, you want to pay attention to rate cuts in the DXY, but there are other elements below that that should be looked at as well. So I wouldn't be surprised to see rates stay elevated. I wouldn't be surprised to see the DXY put in at least a counter trend rally and see risk rally regardless.
See, that's quite interesting because there's, as you've highlighted, so many interplaying, interconnected parts there that will be quite confusing for people who don't really understand each of them in isolation, but probably get the gist that when you put all of that together, it does determine what comes next, and is probably being the confusing part most recently, where some individual components look like they're moving in the opposite direction to what they traditionally would. That's what catches a lot of investors off, I think. But if we turn and look at precious metals, when you zoom out and look at that big picture cycle and all of that evidence you just presented about where we probably are in that cycle, you've highlighted in the past that gold and silver tend to perform quite strongly during this blow off rally phase, but also after the crash. And that seems almost too good to be true for a lot of people. And they probably forget the decades leading up to that, where it may not have performed as well. But you really do highlight the point that if you're correct on all that analysis now and after the crash that comes out of all this, gold and silver are kind of the place to be.
Yeah, look, 100%. What happens in this rising liquidity phase is hard assets benefit. So gold and silver, both being hard assets, do benefit from this phase. But the landscape that we're looking at now, you can see that I'm sort of pointing out that regardless of what happens with rate cuts and the DXY, you're going to see increased liquidity and markets move up. Can you imagine what happens when not only do you have the dollar gaining strength against the yen, but you also have the DXY moving down in parallel? And what happens when not only do you have the MOVE index going down, but you also have yields going down and interest rates going down with it? You could see this perfect storm where all of it is playing out together. People get so exuberant and markets get so over leveraged and flooded with so much liquidity that you start seeing these blow off rallies across most markets. That is completely unsustainable. And what that leads to is the complacency and the greed into the inevitable peak and crash. When you see that peak and crash, gold and silver have benefited being hard assets leading into this. But after the crash and the recovery phase, historically speaking, and there's about 250 years of data for this, stocks and land will struggle for years trying to recover from that liquidity being drained out of the system. But gold and silver at that point are benefiting from, well, gold is benefiting from being a flight to safety. At that point, when you've got systemic instability, banks are struggling, hedge funds are struggling. And now more than ever, you're seeing people move away from the US dollar as debt as well. But regardless of, people moving away from the US dollar and the Moody's downgrade and all this bigger picture 80-year cycle stuff, if you're just looking at the 20-year cycle, gold performs well as a flight to safety. Silver then benefits from speculation entering the precious metals markets because investors that have traditional gold bugs will have been buying gold regardless. But investors that wouldn't even normally be buying precious metals will see gold and silver continue up while other markets are struggling and speculation enters the space. Once you get speculation in the precious metal space, you'll see silver really outperforming because it's got a smaller market cap, and that speculation affects the silver price much more than it would the gold price. The gold to silver ratio falls off. So, that's looking at the 20-year cycle. Gold's a flight to safety, silver's benefiting from speculation. So in the years afterwards, when stocks and land are spending years trying to recover, the gold to silver ratio actually falls off a cliff at that point. And after the GFC, the global financial crisis, it fell from 70-ish to 35-ish. But what's important right now is we're also coming to an end of an 80-year cycle. And you can see central banks stockpiling gold at 5 times their usual rate since 2022. You can see Moody's downgrading US government debt. And you can see the world in general moving away from US government debt as the safe haven collateral. So the previous land cycle might have seen bonds do quite well. And some of that money for safe haven move into bonds, some move into cash, and some move into gold. But this land cycle is the end of a 80-year cycle. And the amount of money that's going to move into bonds and cash is going to be much less than the amount that moves into precious metals this time around. Because when you move from an 80-year cycle to the next and you see human created systems that have lasted about a century come down and collapse and new human made systems get built up, people want to move into a God-given asset that's eternal, that's going to outlast any of these human made systems. And so we're not just looking at a 20-year land cycle ending, we're looking at an entire global financial system resetting, which happens every 80 years or so. And that's where gold and silver will really benefit. So after the previous four turning, they went on a 35-year-long bull run. And the gold to silver ratio spent decades in that 20 to 40 region. So I reckon we're probably on the verge of something like that coming into the end of this and the early 2030s.
Look, one last question to wrap this up, because it's one of my favorite ways to look at this. We all love a little bit of doom and gloom, right? And it's just what's interesting to us. Our brains love it for some reason. We just want to get in there and see what it would look like. What does this top look like in practical terms? Can you paint us a completely hypothetical, because none of us know, that's the whole point, but a hypothetical picture of what this might actually look like when this crash comes? Maybe something around its scale. What would its impact be on everyday people, everyday investors, the sectors or markets, any of that? However you want to approach it. Just to wrap this up, what could it look like for us to know that we're absolutely in that point of the crash that comes after potentially this blow off top that you're talking about?
I think it could look like a number of things, but before I sort of speculate on that, I will just say that it's important for people to not get caught up in this transition, because whatever it looks like, it's going to be messy as you transition from one thing to the next. So having your wealth outside of a human-made system is more important than ever. And that's why having at least some of it in precious metals is that insurance policy. Now, you'll probably get a lot of capital growth out of this insurance policy as well. But let's just put that aside for a second and just talk about preserving wealth. If we're moving from, one multipolar world to, I think, more of a unified world, where we've got some sort of central financial or monetary authority, and we've got currencies that are blockchain based. You've got artificial intelligence that's decimating the job market, and heaps of people are sitting around unemployed. The benevolent people that come to the rescue are going to be the ones that enslave you. So, if you've got some sort of CBDC tied into probably an essential universal basic income to keep people, alive in that time, you've got a hand that feeds you and you can't bite it. So you've got probably some sort of social credit score that's linked to your currency that's linked to a universal basic income, and people are then reliant on this. And freedom is God given. So for a human to try and take away another human's freedom um, is truly evil. And without getting too doom and gloom, if we're getting into that phase now, there is a simple solution to step out of it, which is just having your wealth in something that has been used as money for thousands of years, and not getting too caught up in the transition. Now, we all have to exist in the world. If there's a new system and you need to convert some of your precious metals to the currency of the day, bit by bit, that's something that you can do in the new system. But the point is to sidestep the transition and then re-enter the new system on your own terms, rather than getting churned up in it and then suddenly being like, oh, well, I've got, I need saving now. I need rescuing. And I can guarantee that whoever comes, to rescue you does not have your best interest at heart. So important to sidestep it. Simple solution, gold and silver. We'll end it on a positive note. And
You
just
gave me a little bit. Like I couldn't look away. It was a bit of a train wreck there, where you've got CBDCs and you can't trust. There was enough there, but it is one. Well, we can spend all day on the doom and gloom, but sometimes you need a little bit of that. It certainly gets the imagination going. Of just it encourages people, I think, too, to take some action. So.
Definitely. And it's pattern recognition and just seeing the direction in which things are going. It is speculation at the end of the day. So regardless of what it looks like, AI will decimate the job market. There will be a need for some sort of saving in that situation, and we will transition from one system to the next. So there will be turbulence. Exactly what it looks like, that's just speculation.
I'll keep pushing, don't worry. Look, I always appreciate your facts on this and your speculation. So thank you for your deep dive, as usual. Love all those charts. It really does bring everyone up to date. Really appreciate your work on that today, Drew. Thank you.
Thanks, Chris. Good to talk to you.
Good to talk to you. Thank you, everyone, for watching. We'll chat again soon.